Hello. How are you guys? We good? We're there? Okay, awesome. So first off, I want to thank our panelists and all of you guys for joining us today and this afternoon on the last day of Avalanche Summit. I'm Morgan Krupetsky. I lead institutional business development at Ava Labs. In my role at Ava Labs, I speak with many, many different TradFi companies who are building new products or upgrading legacy infrastructure using blockchain solutions. So historically, a lot of these companies have built on what we call enterprise blockchains, which are totally centralized, owned, and operated by a given institution, and inherently are closed off, not composable, with other use cases, instances, or chains. So the exciting part of Avalanche, which I'm sure you guys all know, is that Avalanche's subnet architecture really enables institutions to have the best of both public blockchain infrastructure development, interoperability, and composability, while addressing at the same time a lot of the kind of compliance, privacy, and permissioning concerns that have historically driven them to make the enterprise blockchain decision. To that end, last month, we introduced the concept of Avalanche Evergreens, which are essentially out-of-the-box subnets specifically for institutional blockchain deployments. So joining us today, we have 3 builders who are in some way building their own or deploying on Evergreen subnets. So really excited to have them share their journeys and their thoughts with you guys. So each of you come from a traditional finance background and are working on use cases that basically cater to an institutional user base. So let's take a moment real quick to just go around and have each of you guys introduce yourselves and at a high level what you're working on. So Sid, let's start with you.
Siddhartha, founder and CEO of Intain, background with Deutsche Bank and State Street and middle and back office operations. Founded Intain. Intain is working on an asset-backed platform. In layman terms, if you have seen the Big Short movie, we are trying to solve for the problems you saw in the movie.
Okay, good afternoon, everyone. My name is Bernardo Corti. I am CEO and co-founder of EMDX. EMDX is a decentralized exchange focused on derivatives on emerging market and real-world assets. Our mission is to become the go-to institutional-grade DeFi solution to trade these kind of assets worldwide. Well, we are working on our Subnet. We will be a Web3 hub for institutional derivative trading, and we will be offering all the features that blockchain and smart contract offers, plus built-in compliance solutions.
Stephen from Aave Companies. So I lead institutional projects. So that can involve DAO initiatives. So on the public deployment side of things, so things like Aave Arc, helping institutions engage with governance. Or more so these days, it's working with institutions on private deployments. So hopefully private deployments on public blockchains. Examples of those are the projects we worked on with the Monetary Authority of Singapore. So helped JP Morgan establish an overnight FX market. And then I was in Brazil last week, essentially helping the Central Bank of Brazil experiment with tokenized Brazilian real.
Thanks, guys. So just to level set, just because generally we have a very kind of wide variety of attendees at our summit, tell us why and how your application uses blockchain. What are some of the benefits that really drove you to select a blockchain solution in the first place? So Siddhartha, let's kick it off with you.
Okay. So I know for many in the audience, blockchain is a very ideological thing, so just indulge me as a TradFi person who looks at blockchain just as a solution for a problem. And I made the reference to the Big Short. So if you've seen the movie Big Short, what actually happens is that everybody is trying to benefit from another entity which may not have the same information. So the issuer knows something which the rating agency may not know, rating agency knows something which the investor may not know, one investor knows something that the other investor may not know. What we are doing is bringing all the participants in asset-backed financing cycle, and these are many, which is issuer, custodian, investment bank, rating agency, investor, servicer, trustee, all on a common blockchain network. And then we are automating the whole issuance, tokenization, and administration process so that the relationship between all of them is completely automated.
Efficient intermediation is what we call it.
So we work with all intermediaries, and that's why I said you'll have to indulge me a bit, because many of you want to remove all intermediaries. We actually work with most intermediaries.
Yeah, in my experience in the derivative industry, I saw many challenges and inefficiencies. I can mention, for example, overlayering of back office tools, redundant clearing operations, legacy systems with limitations that only work from 9 to 5, cumbersome paper-based processes. For specifically when it comes to derivative trading, derivatives contracts can last days, months, even years. So it's a very complex workflow that underpins this industry. But when you start introducing blockchain solutions, you can effectively remove many challenges, thus efficiency start increasing. You can get what is an IT concept called straight-through processing. This is a long-standing concept. For the first time, and thanks to blockchain, we have a true catalyst for achieving this old principle, a true catalyst for quality improving in derivative markets.
Yeah, and when it comes to Aave, Aave is obviously a blockchain native application. So if there's no blockchain, there's no Aave. So thanks to the likes of Morgan for building these blockchains. We wouldn't be here if it wasn't for you guys. But I mean, I've assumed a little bit of knowledge. So I guess maybe just to summarize, the Aave application allows users to supply their assets and earn a yield, or they can borrow against those assets. So Aave and the activities that go on in Aave very closely resemble activities that go on in traditional finance. So any sort of securities financing transaction is essentially very closely resembles the type of activity that goes on in Aave. Just all of this is happening without a central counterparty. And so that's the real innovation. It's that these users are able to transact without any disposal of funds, without having to engage an intermediary.
I think given like all of our backgrounds, in some way, shape, or form, we've been, I don't want to say traumatized, but I've had certain experiences in TradFi where we're like, oh, let's build this solution on chain that can kind of fix or improve a lot of those kind of middle and back office processes that maybe historically have been frustrating. That said, over the past year, I've actually been extremely pleasantly surprised by how progressive institutions have been in this space and have continued to be in this space. Despite market conditions, obviously a very mixed regulatory environment. So I know you guys obviously talk to a whole kind of host of institutions as well in your day-to-day. Give us some insight in terms of kind of how and why they kind of continue to explore the space, what they're excited about. Like, give us some alpha in terms of what their views are and how they're kind of pushing ahead. So Bernie, maybe let me ask you to start.
From the start, an essential part of our growth strategy involved onboarding TradFi operators in order to expand access to institutional liquidity. So as a result, and working closely with these regulated financial players and trying to align our innovative drive with their mindset, their top priorities, their risk management needs, organizational structure, led us to understand and led us it to be our day-to-day operation. This enduring relationship led us also to understand that they are not only comfortable using Web3 solutions, but they are eager to move part of their operations into a Web3 or blockchain-based framework. I think that the blockchain key advantages that they are more excited about is, thanks to smart contracts, you can run workflows in full automation mode with deterministic execution. And for example, when it comes to derivative trading, smart contracts can run complex operations like acting as clearinghouses, to storage collateral or to perform mark-to-market operations. They can also facilitate liquidity provision. Even they can act as keepers to control and monitor collateral management and settlement processes. So I think that it is the thing that they are more enthusiastic about.
Anything you guys want to add?
Sure, so I'll take two examples maybe on how broken things are in TradFi and things could improve. So what we worked in is asset-backed securities. People are obsessed with tokenizing securities, but there is an asset backing that security. So in traditional finance, what happens is that the security is backed by 100 loans. You'll have to go do a due diligence on those 100 loans. The entity doing the due diligence, which is a verification agent, could be an auditor like Deloitte, or a custodian bank like BNY Mellon, and you go through individual loans. What blockchain is allowing us to do, we use an AI engine to read all those loans, create an exception report, a BNY Mellon kind of custodian looks at that, certifies, and I create an NFT on the subnet, which means that the identity of the loan, which is the asset backing a security, is now established on the subnet. So for all future transactions, you don't need to do another due diligence. So if you think of it from TradFi processes, so due diligence is one, reporting is another. At the end of the month, all money collected against loans after 15 days is reported, which means 30 plus 15, 45 days. You do a couple of reconciliations, you are at 55 days. So something that happened to my pool is known to me as an investor 55 days later. With the blockchain, use of smart contracts, that is straight through, and I know real time what's happening to my portfolio.
Yes, and so the question was why they're still involved, right?
Why they're still involved? Like, what feedback do you get?
I think, like, first and foremost, it's a super interesting problem or super interesting challenge to be working on. So, like, most institutions I speak to have been working on digital assets and working with blockchains for like 5-6 years now. They've all built out the resources, so like the infrastructure's there. They've all spent time working on Hyperledger, R3, all these private chains, and slowly but surely starting to graduate. So like that's the first thing. So like the resource is there, the commitment is there. Like in November, obviously it was a difficult time with FTX, but in the aftermath, I think there was op-eds from BlackRock, Goldman Sachs, BNY Mellon. The CEOs all came out and kind of committed to tokenization, digital assets. So the resource and the commitment is definitely there. And then in terms of why they keep doing it, I mean, it's like the same as anybody, right? Everybody wants to make money at the end of the day. So like these markets essentially open up, or these I guess these markets do open up new markets for the banks working in the space. So that's another thing, obviously.
Yeah, I think you'll agree with this, that there's definitely institutions kind of out there in the space that quote unquote get it, and that understand that the kind of developments, the negative developments over the past year are different than the underlying technology, and they've spent a lot of time kind of educating their clients, their boards, their executive management team members to say, this is what that was, and this is different than the underlying technology, and this is why the underlying tech still has promise. And you know, we have these like internal champions and cheerleaders that are really kind of driving things forward in the space. But that's actually a good segue, Steve, to the next question. So you guys all have very different journeys that actually ultimately led you to build on an evergreen subnet. Siddharth, for you, from Hyperledger to the Intain markets build on a subnet. Bernie, for you, from the Avalanche C chain for retail to the institutional EMDX subnet. And then Steve, for you, from various chains, including the C chain and others, to Aave's launch on the Spruce subnet, which was launched a few weeks ago. So maybe Steve, why don't you kick us off in terms of talk to us a bit about that journey and what factors kind of you guys took into account that really led you to conclude that you know, a subnet, an evergreen subnet in particular, i.e. an institutional subnet, was kind of a good idea.
Yeah, I think most relevant was probably our work with Aave. So for those of you that don't know, Aave is a permission version of Aave. So the way it works is that there are whitelisters who KYC users, and then the users are able to interact with that pool. So that was really, I guess, one of the first, or one of the more well-known forays into institutional DeFi and permission DeFi in general. And so it did all right. So at peak, I think the TVL was about 100 million, maybe about 70 users, and we had those whitelisters onboarding users from various different jurisdictions. So a couple in the US, Fireblocks and Securitize, and then Seba Bank in Switzerland as well. But one of the main challenges really was that multi-jurisdiction piece. And so that's something the regulators didn't really ever get comfortable with. And so just thinking about like the next evolution of what like a permission market would look like I think it's much more in line with the vision with Spruce. Like in my mind, the KYC, it shouldn't necessarily be specific to the protocol. It's just very limiting. Like you lose a lot of the benefits of composability and everything else. Like I think the approach we're taking with Spruce here is a lot more bottom up. So it's KYC at infrastructure level. You onboard all of the applications, and then you're able to interact across the board. So that for me is why it's interesting.
So we have been building on Fabric. So we have an administration platform called Intain Admin for 4 or 5 years. When we had to add the tokenization layer, then we had to look at a better platform which would allow tokenization, but we still wanted to remain in a permissioned environment which we could control completely. And control completely not in terms of what's happening on the platform, but for example, every node is hosted inside the United States. Every validator is an identified party, which is either a US institution or a US resident. So Subnet allowed us these advantages because without this, institutions would not come on board a blockchain network. And the additional part is that what we are trying to offer to institutions as an investor is, as I said, that you can do the due diligence on that token on the network itself, which means that what is lying behind the token should also come on the network. If I'm on a public blockchain, it is impossible to convince somebody's asset or the data about that asset to come to the public network. But now with us, what we can do is get people to put their underlying loan data on the subnet. So on our subnet, if you zoom into a token, you see all the loans, you see all the data of that loan. So it's like DD on a subnet, which wouldn't be possible otherwise.
Okay, in our case, we've been live on Avalanche C-Chain for a while, and it's been kind of a little difficult to onboard and attract institutional players. That's why we started looking for our solutions, and that's why we found that Evergreen Subnet is a suitable solution. The main reason is that it's specifically designed for protocols like EMDX or these protocols that are looking to onboard traditional financial players, because you can set up, for example, KYC, KYB, AML solutions as rules embedded in code, and that's super useful to interact with institutional partners. Then I would like to highlight that there is something super interesting, that there is a highly skillful team and committed team behind Evergreen Subnet, and this is also really important when you start developing a protocol, because the protocol developers will always need support along the way.
I didn't tell him to say that.
Yeah. Finally, I think I would like to highlight also code granularity and flexibility, because it's something that, for example, when you run derivative markets, you need to assign different permissions to different agents, so you can set, when you configure your subnet, permissions for different roles. For example, for broker-dealers, you can grant them access to certain type of data or to run certain actions. But if you, for example, decide there is, for example, a regulatory body that joins your ecosystem, you will grant different permissions for different type of data. So that solution really fit what we are looking for.
I think why some of our institutional partners are excited, frankly, why I'm excited about this also, and you guys all touched on some of these things, but the ability to write in certain rules, whether it is KYC and KYB or other rules, right? It could be jurisdiction-based, it could be, you know, entity-based, but to the ability to kind of build all of that into the core infrastructure level, while at the same time maintaining the optionality to kind of open up your network to the extent regulatory clarity allows for it at some point down the line, the extent that to which they are interested in or it's relevant for them to interact with other subnets. That's what we haven't really talked about yet, but the ability to potentially have, let's say, a Goldman Sachs subnet and a JP Morgan subnet, they each have full control over their validator set, but they maintain the optionality to start trading with each other in this kind of in this you know, broader blockchain environment, which in the current iterations of their current solutions, which are on enterprise chains, obviously they can't do that without the reliance on third-party bridges, which, you know.
Yeah, and on that, like subnets for different jurisdictions or subnets for different asset classes, like that would be super interesting.
And people also forget subnets can be multiple chains within one subnet. So you could have, you know, a subnet for each business, a subnet for each geography or each asset class, like whatever it is, Steve, to your point, you know, whatever the use case kind of calls for, it can be kind of malleable and customizable for that. So appreciate your guys' kind of support and really looking forward to kind of the build out of what these will look like. That said, not everything is all like flowers and roses. So obviously, you know, change and broad adoption, especially in the TradFi landscape, will take a lot of time. A lot of these, not just partnerships, but use cases take many, many months, if not years. And while we have seen a decent amount of traction and optimism, you know, obviously challenges, blockers, and hurdles kind of continue to persist. So from your various perspectives, can you maybe outline what you guys have found to be some of those barriers, whether in your own go-to-market strategy or from like a broader institutional adoption perspective, and how you think either you or we as an industry can kind of help push this forward? Maybe Siddhartha, if you want to, I know you've been at this for a very long time, so maybe you could start.
So two things which get often talked about, they for us are short term because means we run the process exactly how TradFi runs, so we don't have regulatory issues. It means short-term fear, uncertainty, doubt does impact sentiments. And that's why the way I see it is challenge really is not from TradFi. When we started building the tokenization platform last year, after having been in this for 4 or 5 years, I realized that the big challenges within the blockchain industry itself, the custody solutions in blockchain industry are absolutely broken. Custodians in blockchain industry charge 20 bips. Custodians in TradFi charge 2 bips. So is the whole idea that this is a disintermediated world is nonsense if the intermediary here is charging 10 times what the intermediary in TradFi is charging. I think the fix, what I'm more positive about, is that TradFi institutions taking up roles in blockchain. So a BNY Mellon starting to offer digital custody will fix custody. With a lot of large banks having liability tokens or deposit tokens will sort out the payment stablecoin problems. Because if these two things get sorted out, then I think everything else in the whole transaction journey is sorted out already.
Yeah, basically, in our case, you know, I think, in my humble opinion, the biggest barrier is that tech staffs of many traditional firms have not the right skill to develop blockchain solutions, blockchain frameworks, and blockchain tools, and that's okay because that's not their cup of tea. But you know, we as Web3 developers, kind of, we try to share on a daily basis all our know-how and knowledge. You know, we have an interesting case with Madbar Rafex, which is our main partner. They are the largest commodities derivative exchange in Latin America, a company with more than 100 years in the market. And we, part of our agreement was that we were going to help them set up and run an in-house Oracle node for them to be able to inject market data, specifically price feeds, that in turns are used by EMDX to build derivatives on top of that. But not only EMDX, can pull these price feeds. Any other DeFi protocol out there on Avalanche can use these price feeds. And that is super interesting because it is a win-win case, because now they have at least 4 benefits. One, it was their first use case in the real world interacting with blockchain. Then it is, they became part of the crypto industry as a market data service provider. It is a risk-free service from the legal point of view. And I think the most important is that it became a new source of revenue for them. And it's super useful when you try to push forward projects like this within traditional organizations.
So in infrastructure, I'm hearing education, partnering with institutions to kind of bring them along for the journey, probably maybe some legal hurdles to go through. Steve, anything to add on your side?
Broadly agree. Operational side of thing, like banks are always interested in stuff that's interoperable with their existing systems. So, yeah.
Cool. So, looking ahead, maybe 5-10 years down the line, what do you think? Like, what does success look like for you guys? What is like the target state vision as it relates to like financial institutions on chain? What are we trying to strive for? Anyone can take this one.
Yeah, well, and I guess kind of goes back to the challenges first. Like, I think there's broad acceptance that institutional adoption of DeFi is going to need some form of verification. So, like, I think that's going to happen. So, you're going to have that, and you're going to have some sort of identifier to users on these chains. But at the same time, you're still going to have, in parallel, native DeFi. Like, native DeFi and true DeFi, you can't shut down. It's just, as a user, you are going to have to make a trade-off as to whether you want to maintain anonymity or whether you want to go where the liquidity is, in my opinion.
We operate in a space which is in US itself does about $2 trillion in issuances a year. That's T for Tokyo, just to be clear. $13 trillion in outstandings. We would want to see in 2 to 3 years' time at least 10% or so of it starts at least being administered on blockchain networks, even if not traded. And that would be a big thing, because just simply 150 bips transaction cost can be brought to 50 bips. So for me, Holy Grail is not a fully tokenized world. Holy Grail is 10% of the structured finance or asset-backed assets in the US being on any blockchain network.
I think that'll manifest itself, to your point, in cheaper transactions, incremental revenue for some incumbents. So I think it'll manifest itself in these concrete ways, but kind of not in separated as like the crypto or blockchain industry, but in traditional financial markets.
Also, good quality assets from lesser known issuers. So currently, for example, the big stories we talk about, Apollo use case and KKR on Avalanche or Hamilton Lane, all these cases, the blockchain industry needs them more than they need blockchain industry in the short term. The assets that are coming to blockchain, we discussed earlier, come because of adverse selection. So people who couldn't raise money, poor quality assets, end up trying to tokenize. The world in future would be good quality issuers with good quality assets who do not have the big brand name recall, but because they can offer transparency on the blockchain, they would want to say my asset quality is as good as Apollo or Hamilton Lane's asset quality, which I'm establishing on the blockchain, and hence give me the same cost of capital that you give to Hamilton Lane and Apollo. So that, I think, is the future, really.
We have a master plan for that, but stay tuned. Bernie, what about you?
Yeah, I'll be very brief. At EMDX, we aim to establish EMDX as the go-to platform to trade emerging market assets worldwide, to offer a comprehensive suite of derivative products. And the idea is to unleash all the economical power that emerging market has locked in currently. So I think that by doing that, we will be playing a significant role in the blockchain space and driving massive adoption to the institutional space.
Awesome.
Well, I started there, so I mean, I'd also add, I'd like to see Aave for more traditional assets. So like an Aave SEC lending pool, Aave bond refinancing, Aave for everything.
All right, thank you so much, guys. Really appreciate your time and for joining us today. I appreciate everyone here for joining and listening in, and stay tuned on the institutional front.
Thanks a lot. Thanks.
Thanks.